In mainstream finance, we're always looking at the same handful of indicators. It's actually quite an embarrassment. US unemployment rate, US stock market, 200-day moving average, PE ratios, and a couple of others. If any of these turn sour, we'll just say it's temporary. Even if it isn't, the Fed will fix it because they love us dearly. Well, they love me, don't they? You came here for the truth, so let me unveil that for you. Today, we're going to look at the US economy slowing down and the stock market growing. I'm going to show you the disparity in between the two. I believe it's important for this to be a distinction in between the two. There isn't a US economy and a stock market in one. It's two very different things. One is much easier to manipulate than the other. So let's begin by taking a look at the markets. Here you can see the differences between the Dow Jones and the S&P 500 and NASDAQ. The Dow Jones had moved into the negative today over 100 points, and that's very different than the S&P 500, for instance. It started off the day quite low and has moved up ever since. This is a recording at just after 3 p.m., so I'm sure that it will move into the positive by the end of the day. If not, it's just a small amount below the line. We'll see how tomorrow goes. Usually they will just push this up higher. It's Monday though. Definitely by Friday they'll get that to strengthen, as long as the plunge protection team is not on vacation this time around. This is the same situation for the NASDAQ. It was down in the morning and found its way up into the positive at the end of the day. Now we would think that there's some great news that came out to make this go up higher, right? I mean, there has to be something, some bit of good information, but of course not. That's not the way it works anymore. All we have are central banks, stock buybacks, computer algorithms, and a whole bunch of garbage. Equity trends remain steadfastly bullish, but are now getting stretched and have arrived at near-term areas where resistance could set in. This article is talking about how the Dow Jones fell by over 100 points, and they're suggesting that this is related to Boeing. It's pulling the rest of the stocks down. They get into some details here. Momentum is nearing overbought territory yet again after one of the best quarters in over 20 years' time, while the groups that have led this rally, namely technology, consumer discretionary, and industrials, are now up to levels near prior highs, which are thought to be important from a price perspective. We have seen all of these different stocks, whether it's the FANG stocks or so many others, that have moved up, in some cases, 30% from their lows. We are now right around that point of these stocks being at the same level they were back in the peak in 2018, for many of them anyway, and it looks like they will surpass that. They have gone far and away, all because of trade optimism and also the fact that the Federal Reserve apparently is never going to increase interest rates again, and the market is actually beginning to price in a rate cut. So that's what we're seeing here today. Not any physical actions that have actually taken place. Nothing at all substantial has occurred, and yet the market goes higher. The actual fundamentals, though, are showing us we have reason to worry. So we'll look at that today. US factory orders month over month, out of the last 5, 4 of them are in the negative territory, and the one that's in the positive looks quite dismal if you ask me. This just shows us that we have seen this weakness that has been persistent. It doesn't necessarily mean there's going to be a recession tomorrow because US factory orders month over month are declining. No, but it tells us one piece of the puzzle. It's a small piece, but surely we should pay attention to it. US manufacturers new orders total. This just gives us an idea, in conjunction with that we had the peak back in what looks like September and has been declining ever since, along with everything else. What's interesting about this is that they were completely correlated prior to this, and there has been a severe disconnect that has occurred ever since. Looking at this next one, I've talked about the car sales before, how terrible they look, and all of the delinquencies in the United States. 7 million people are delinquent in the United States on their auto loans. Well, we've got an issue here, and it extends into this article. Out of Bloomberg, stronger than expected new car sales last month belied a dirty little secret. Automakers have been selling more vehicles to rental fleets in recent months to prop up the volume. We've got an issue. See, it's not going to individuals. It's not being sold. It's being sold to these rental fleets. These people are going to have their cars sitting in these lots at lower profit margins, but what it does do is it makes the market look much better. At the bottom, they speak the truth. Any favorable view we have of the market is because of sales into fleets. The market peak of 2016 is behind us, and retail sales are softening more and more now. That's what you got to know. This is the real deal. Look, you cannot extend the cycle forever. I don't care what they tell you. It is physically impossible. There are periods of time when it comes up. There are periods of time when it comes down. You don't know necessarily where you are, but you need to make your bets accordingly. This is the way that it works. If you're always in this assumption that the stock market is going higher, eventually you're going to get burned by it. Many people don't understand the way that this works. Nobody predicted what was going to happen back in 2007, 2008. It's funny the way that you see all of these analysts on TV or in these articles, and they say, you know what, it doesn't look like it was back in 2008. It doesn't look like that. We're not seeing that. No way. You didn't see it back then. You're not going to see it today. And I'm not suggesting that something's going to happen tomorrow, but I'm saying that all of these people that are telling you everything's okay are the ones that didn't see it last time around, because it pops up out of nowhere. It only makes itself visible after it's too late. You will not be able to anticipate and be able to maneuver. It doesn't work like that. It never has before. There are only a very small select few people that were able to determine any of these previous crises that we had before, and I assure you it's not going to be in the mainstream news. So you can't rely on that. It's very, very careless. Flooding fleets. Rental car companies were significant sources of vehicle sales in March. Just showing you that, comparing the different companies here. I know you're here for the truth. I found this out of Real Investment Advice, and I think it's important for all of the people watching this to understand unemployment. This is a fake number, and it's completely manipulated. I have an entire video about the unemployment rate and why it is fake. If you go to the end of this video, I will put a link there for you, but for now, let's just talk about this. We are looking at the U3 and participation rate adjusted U3. In that video, I talk about the participation rate and what it means, okay? We're looking at this, trying to discover how many people are not working. The U3 rate doesn't tell us that. The participation rate gives us a better look. And if you were to use this, the blue line is the participation rate adjusted U3. It paints a completely different picture. The rate is 8.16, not 3.8 like they tell us. It's 8.16. Very interesting. Another way to look at unemployment. There's of course shadow stats, everybody knows, but I thought this was different because everyone's always looking at the shadow stats data, but to see other types of data, it sort of gives us an idea. Now, I don't know if 8.16 is accurate. I really can't determine that, but is it 3.8? No, we know that's not the case. We know that's not the truth. This right here is interesting. Mentions of labor costs on earnings calls is at an extreme level. Okay, so they're getting all the transcripts of all these earnings calls, and it's interesting actually what they can find from this, and I found this to be quite impressive compared to all previous history back to 2005. It didn't even look like this at all during the financial crisis. You can see it has gone into a level that is basically double or even triple what we have seen in the past. So looking at this, it is a very big concern for individuals and their employment, because I think that next time around there's going to be some serious mass unemployment. These places, whether it's retailers or whether it's financial companies, the most expensive part of their business in many cases tends to be employees. It's labor. They can get rid of a whole bunch of people in an instant, whether they have to give them severance or not, depending on the situation. And maybe they're working part-time, maybe they bring them full-time into part-time, so they're not necessarily getting rid of them, but they're too few hours, but the economy's not so good, so they take what they can get, or they don't like it, they quit. This is the way that is done every time around. If you were not involved in the financial business back in the previous crisis, you can ask somebody around. I'm sure that they will give you some of these inside information about how it all went down. Well, JP Morgan, I just wanted to let you know that you've made some comments here that are just racking my brain. All right, here we go. We're all used to using the word cycle. We're all used to looking at historical charts and graphs and equations and relationships. The reality is that maybe the word cycle is no longer even relevant given that we have so much unconventional central bank involvement. And I do believe that there are serious, very serious distortions that central banks have created today. But to suggest the cycle is over, this is extremely dangerous talk. And that has really stretched everything. The amount of margin people are using today, the extreme bets that you're taking today, all the derivatives are because we think that the central bank is going to be there to fix the mess. You're making a big mistake. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you are supporting this channel, so I do appreciate that very much. If you want the financial education you weren't taught in school, these two books have everything you need from A to Z, from top to bottom. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to find out why the unemployment rate is fake, it's false, it's a lie, you got to watch this video. I break it down step by step. Click on it and I will see you there.